Hello and welcome to this month's CFO On Demand webinar series. Before we get started, we're excited to show you next year's series of webinars. We have them listed here on the screen. You have one left in December for the 2018 series and our 2019 series. The first 6 months are exhibited here, and then we will show the rest of the year next month. So please join us if you can for the future webinar series. Okay, let's get started with our webinar this month. This month's webinar is budgets. I changed the title a little bit, so worth the time. It's brought to you by CFO On Demand from Fitzpatrick, Bongiovanni, and Kelly CPAs. Please support our sponsors. This month's sponsor is Sturdy Savings Bank with locations in Cape May County and Summers Point. I'm Lou Bongiovanni. I'm co-managing partner of the firm Fitzpatrick, Bongiovanni, and Kelly, and I am the head of CFO On Demand. I'll be your speaker today. In the past, I've encouraged you to type in questions based on some feedback. I'm suggesting instead of doing that, please email me. You see my email address there on the screen. Please feel free to email me any questions you might have or comments concerning this webinar, and I'll be glad to get back to you promptly. Now for our webinar. The objectives of this month's webinar on budgets is such. We're going to look at the 3 budget approaches. We're going to discuss 4 budget types. We're going to talk about the actual budget process. I try not to make this a how-to webinar, but we're going to touch on the actual process so you get a feel for it and how it works and how we work it through CFO On Demand. And last, we'll discuss 7 factors to getting the most from your budgets. Let's start with a definition, because different business owners' perceptions of budgets can vary greatly. Mostly there's a negative connotation to budgets. It feels restrictive to business owners. You're basically telling them what they can't do. And we at CFO On Demand look at budgets completely differently. But just by definition, a budget is a financial process and plan for the future concerning revenue and costs for a business. So that's the formal definition. I've emphasized a couple of words here, and that the budget is a process, and there's much to be gained in the process itself, not only the output. It's also a planning tool that can be used to do different what-if scenarios. When used properly, budget is a very powerful and integral tool to the success of a business owner, and especially one who is a strategist. Some things it's not, or one thing it's not a diet for your business expenses. People think, okay, you're going to slash my expenses in the context of this budget, and that's all we're going to get out of it. It's much more than that. I really view it more as a pinpoint focus on the company's goals. It allows you to narrow towards the company's goals and not really lose focus on where you want to go in this upcoming year. The reason that we're talking about budgets right now is that this is the time when most business owners are looking at their budgets for next year. They're starting the process in November, fine-tuning in December to roll it out in January. So we feel that doing a webinar now is very timely. So let's start with the different budget approaches. All right, there's 3 common budget approaches, and many business owners who do budgets don't really think this formally about it, but we want to at least make you aware of it. One is called the imposed approach. The second one is the participative approach, and the third one is the negotiated approach. And I'm going to discuss each of those approaches in a second. The one thing you do want to keep in mind is that most companies don't just do one approach alone. they'll do a hybrid of different approaches with emphasis on one approach versus another, and we'll talk about that. So first, the imposed budget approach. That is the most common one. It's usually dictated by ownership. It's also referred to as the top-down approach, ownership at the top, passing it down to management and employees. Employees identify the resource and cost needed to achieve the budget. So the owner says, we're going to have revenues of this amount, for example, and then he leaves it up to management and the employees to determine what they need or what the cost structure is going to be in order to achieve that revenue. It's also referred to as an activity-based budget, where the owner might say, we're going to do this particular activity. The activity might be opening up another branch or another product line. They identify a particular activity and then build a revenue and cost structure around it. The advantages of the imposed approach is that it's a time saver. It's real easy because only one person is involved in the process. You remove any lower staff biases. So if staff has a big contribution to it, there might be some biases there. And ownership has total control, which many small business owners like that very much, as having control, complete control of their budget. This budget is best used when you do not have a strong middle management level, where it's the owner and then most of the employees. There's a big gap between them and the owner. You see this rather often. Next approach is the participative budget approach. In this approach, the employees create the budget, so it's referred to as bottom up. You're giving the power of the budget to the employees. Now, the owner gives some general guidelines, but pretty much the employees run with it. This is also referred to as a zero-based budget. You may have heard that. A zero-based budget is one where you're not really starting with last year's numbers and adjusting up or down. You're starting with a blank sheet of paper, and you're creating a budget from it. The advantages to this type of approach is that you have the employees buy-in is rather high because they're taking ownership of it, they're authoring it. This type of approach is best used when management is restructuring the company or imposing quite a bit of change and they want the employees to buy in. So many entrepreneurs, maybe not every year, encourage change in their companies in order to grow, right? Change is instrumental to the growth of the company. That's really the cornerstone of what we do quite a bit at CFO On Demand. So this type of participative approach is taken when you want the employees to really get an understanding of the budget and take ownership of it. Many times there is incentive compensations tied into the budget as well. So you want the employees to know exactly what they're buying into for this given year. And the last approach is called the negotiated budget approach. This is a hybrid of the first two approaches. It's ownership and employees create the budget. It's a bottom-up and a top-down combination. All right. Ownership gives guidelines again, but there's a give and take. There's clearly a collaboration in preparing this budget. You get feedback. You're able to strategize with the employees as well in this. This is best used when you have experienced management who gives feedback and is invested in the company. This type of approach is more time consuming because you're soliciting information from management, you're trying to collaborate, you're making different modifications to the budget, but by far, this is the most comprehensive and the most effective budget. Now, companies don't usually take one approach each year and stick with it. Depending on what's coming down the pike, they may or may not take a particular approach. If there's quite a bit of change, they might lean more towards the participative approach. If there's not much change, you'll find that they will do either the negotiated approach or the imposed approach. So it can vary from year to year. So one approach does not fit all for every company every year. But it's important to understand these approaches so you can adjust accordingly and let the employees and specifically management know what their expected roles are. Now let's talk about the 4 budget types. There are different budget types. These are the 4 most common budget types for small and medium-sized companies. They are the operating budget, more commonly referred to as the income statement budget. There's the cash flow budget. There's the financial, or again, more commonly referred to as balance sheet budget. And there's capital expenditure budget, or capex is what you normally hear. So these are the 4 types of budgets that normally get created by a company each year in order to prepare for the upcoming year. We're going to explore each of these in more detail now. Okay, the operating or income statement budget. All right, this is the budget that's most common. If any company does any particular budget, this is the one that they'll do. This is projecting out your revenue and related expenses for the upcoming period of time. It's usually a year. What you're factoring in these budgets is the fixed versus variable costs. Fixed costs move much less frequently. Variable costs will fluctuate depending on the revenue that's projected. It's most commonly done monthly. I'm going to show you an example of it in a minute. And it takes into account seasonal and cyclical influences. So, for example, if you do have a business that has some seasonal or cyclical trends in it, this budget will take that into consideration. You're not just going to say, okay, sales are 1.2 million, it's 100,000 a year across the board, boom, we're done with revenue, boom, 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 go forward. That's really not how this goes. You're really looking at last year's, mostly for a guideline, or last couple of years, and you're trying to predict the trends, and then you're taking into consideration the plans for the upcoming future as far as how those plans may influence your numbers. All right, next is the cash flow budget. The cash flow budget picks up where the income statement budget leaves off. So the income statement budget provides you with projected net income as the end result, and again, mostly on a monthly basis. The cash flow budget starts with that net income, makes cash flow adjustments to it to determine what the actual cash balances are going to be in the bank account at the end of every month during the course of the year. So it predicts the changes in cash flow as a result of 3 factors: operations, investing, and financing. This is actually the most important budget. It's used in many instances. One, it's used by the banks in order to help determine renewal of lines of credit or loans. It's used by the business owner in order to determine capital expenditures, as well as how much they can take out of the company. It's a critical budget. I'm going to show you how that's done as well. Just doing the income statement budget without the cash flow is really giving you only a part of the picture. The third budget type is the balance sheet budget. This one is least commonly done by business owners. It's not done monthly usually. If it is done, it's done on an annual basis. This is taking your balance sheet and projecting it for the end of the year. Again, I'm a big proponent of budgets, big advocate for it. I like looking out at least 1 year. Some want to look beyond that, which is wonderful. But with the balance sheet, you want to see what the balance sheet will look like a year from now. So you're saying, what's the cash balance going to look like? Well, you get that from the cash flow statement. And then you look what the assets and liabilities are going to look like. This is a tool that's commonly used for startups to obtain financing, but it's also referred to when you're looking to value your business and see the change in value of your business. When you refer to the balance sheet into the future, that has an impact on calculating the value of your business. And the last type of budget I want to discuss is the capital expenditure budget, or the capex budget. This predicts the cost of capital improvements that you make to your property. So these are physical improvements, whether you're building a new location altogether or you're making improvements to your existing location. That's what commonly referred to as capital improvements, as well as equipment or furniture and fixture needs. And these are called fixed assets. So you might need trucks, you might need equipment, or you might need to buy furnishings for your business. That's another component of the capex. So they're the two main components. In larger companies, medium-sized companies, it's usually done by department. So the restaurant might have a capex budget. The golf course might have a capex budget. The banquet hall might have that. The fitness center might have that. If a company has all those particular components to it, each department or division would come in with their wish list, and then you need to negotiate and prioritize, because you might not be able to afford everything in a given year. So you might say, hey, can you wait another year for that because this one's more urgent? And that's where the planning part comes into the process. You don't want to only buy things when they're in dire need of repair. You want to try to stay ahead of the curve. The best employers, the best entrepreneurs all stay ahead of that curve and plan accordingly. All right. And I'm suggesting the best is done in a 2-year window as far as looking out, because capital expenditures are usually of a larger need here. Also, with this budget, it's critical, if you do have bank financing, that you share this particular budget with the bank as well, because they're interested in knowing what's going on, and if there's any financing need. They can't act real quickly with that. They do need to have time, so it's good to let them know what your needs are. Okay, next, let's talk about the actual budget process. Give you some insights. We've talked about different concepts here, but for those of you who aren't familiar with budgets and haven't done them, I want to just actually talk about the process. This is something I do about 20 to 30 times a year, so I'm rather comfortable and familiar with the process. One process does not fit all. This is the process that we use for most companies. It could vary a little bit, but overall, the process can be broken down into 4 components in my mind. One is preparing the annual business plan, and we'll talk about what that is for a company. Determine who should participate. We talked about different approaches that'll impact who participates in the process. Using spreadsheet templates, I'll give you an example of that. And lastly, establish due dates for final approval. Have a timeline for this, or else it won't be implemented on a timely basis. So let's talk about the annual business plan. So the annual business plan, it might sound pretty comprehensive, but it doesn't have to be. It's usually a narrative, commonly less than 5 pages. Some of them are about 2 pages. And really what that does is it communicates in a narrative form what the plan is for the upcoming year for the company. You could talk about the external impacts of, let's say, competition or regulations or the economy. You could talk about internal opportunities with a new product line or a new service line, or a great staff acquisition that you made. You're talking about, it gives insights to the owner's mind as far as how they see the next upcoming year. It's a great way of communicating in a narrative format what's in the owner's mind to the employees and to management. Also, management has a piece of this, depending on how higher up your management is, as far as what their insights are and what their goals are. So once you do this business plan, everyone's on the same page in a narrative format. Then you now translate those plans, those aspirations, into a spreadsheet, into the financial format. So that's the business plan, and many times you're using a similar template and you're updating it. Especially with companies that do have a lot of change, this one's critical. All right, next is the budget. Next in the budget process is determine who participates. This is somewhat self-explanatory. We spoke about this. Depending on what your approach is, if it's an imposed approach, you're going to have ownership and very few people participate. They're going to only participate to the extent that they're going to be asked to implement the budget that's imposed upon them. The participative, obviously, there's a lot of input from management and department heads, and the negotiated is a combined one where both sides have somewhat of a role. So depending on your approach, that's it. But overall, you have ownership is set mostly on goals, is focused mostly on goal setting, and management is focused mostly on tactical and strategic influences of how to achieve that revenue goal that is set. As far as the budget process, I'll talk about that now. As far as the budget process, we use spreadsheets as far as to communicate and share the financial information. We spend a significant amount of time on the revenue projections, and that's why the connotation of a budget is, okay, just slash costs here is really a false one as the way we use it. We probably spend 50% of the time on revenue, which might be just a handful of line items, and the other 50% of the time on the expenses, which were clearly many more line items. But it's important that we fine tune that revenue projection because so many of the expenses relate to it. You want to use a template. You want to have a shareable spreadsheets was very easy to do in Excel. It's good to have prior year or year's information handy so that you can do it. So it's important to get all this information lined up. It makes the budget process much quicker. Now I want to show you a sample of a profit and loss and income statement budget and walk you through it a little bit. So let's see if I can get that working. We have that working here? Let's see. All right. So here, again, I'm not going to treat this as a what if or as a how-to, I'm sorry. But so what you have here, and these are all fictitious numbers, but just to give you a flavor for it, so that you would break it out monthly, you would have the revenue, you would project out what you are anticipating it to be. So this is 2019. So this part you had 2018 handy. You look at 2019. Sometimes you have odd numbers like this because they might do some percentages of increase. And then here off to the right, you have a column for assumptions. You could either number them and then annotate them down below, or you can put them here in little phrases, which you see a combination of the two. So you start with the income line item, and you really drill down this particular one just so you can see the spreadsheet. We just have in one line item, but many times it's here broken down by product line or service line or location. Then in this case, they're a packaging company, so they have a cost of goods sold. So we have it here. And then we monitor what the gross profit trend should be. And if it fluctuates, we want to make sure we understand why, and if that's an accurate assumption, or is there something we could do to change. This one has fictitious numbers, so you do see some fluctuations here. But here, why is there 5% gross profit margin in 1 month, and then the very next month it's 40%? Obviously, I doctored up some of the numbers there, but things like that would come into play. And then you have the different expenses. You see off here to the left, we indicate from a V for variable and F for fixed what type of costs they are, because that might give you some insights in preparing the budget of what you think should move as far as if you've changed some revenue numbers, what should move and what should pretty much stay the same. When you get to the bottom of this particular spreadsheet, what falls out is your monthly P&Ls. This all will then go into your software. If you use QuickBooks or whatever the case may be, you can put this all into the budget module, and you see budget to actual every month, every year. It works beautifully. All right. So that is your income statement budget. I just, for purposes of ease, I just scroll down here, and we have the cash flow budget. So again, as I mentioned to you before, it picks up where the net income was from the income statement budget, gets put here, and then you put factors in that influence cash flow, and you make those adjustments to it, and then you break it down by operating, investing, and financing. They're the different categories. We've talked about cash flows in prior webinars, so I won't rehash that. But you see what the changes are to that so that you have a good idea of what the cash balance is at the end of each month. At the end of each month. So this helps when you're trying to guess what the balance is. There it is. Just playing with the mouse a little bit. And that's it. So you can then have your assumptions down here as far as revenue increases or cost increases. And this will now give you an idea of where you're going to end from a cash standpoint, where you could expect to be at the end of the year versus the beginning of the year. Okay, so that just gives you a flavor for it in the spirit of time, but just give you an idea when we're talking about budget and the process. That's a quick demonstration. Okay, back to the spreadsheet. All right, and the last point in the budget process is establishing due dates for final approval. Everyone's busy. The people who you have involved in the budget have other responsibilities. It's really important, especially the bigger the budget, the bigger the company, the more people involved. It's important that you have set dates so that they can be reviewed and then finally approved and then put into the software and moving forward with it. So that is critical. It's one thing to do it. If you don't have imposed deadlines, you have budgets that spill into, okay, you don't have it done until February or March. Well, you've lost some of the benefits of it that way. All right. Now let's talk about the 7 factors to get the most from your budgets. All right. Number 1 is the process is as important as the outcome. As I alluded to in the definition, this is a plan as well as a process. The plan we talked about can be narrated in the business plan that I recommend you do an update every year. You want to get the employees involved to get their buy-in, whatever approach you choose to use. In my opinion, it's very critical to get the employees involved in it so they're committed to the budget and they see it on a regular basis. And this also helps in the process to determine what financing is needed and when. So it's important that that you go through the process, you have those kind of discussions, you have strategic and tactical things that they get brought up, and then the outcome is what falls out. Number 2 is the best owner communication tool. What I love about the budget is it gives the owner an opportunity to say, time out, let's formally talk about things that we need to do in the upcoming year in order to make improvements. Sometimes it's awkward to find the right time for the owner to have that kind of discussion comprehensively with the employees. The budget gives you a perfect time to communicate, and nothing's better. I don't care whether you're a team or a company or in a relationship, communication is critical, and this is a great communication tool. When one of there was a survey of successful business owners, and it was asked, if your best friend was going into business, what piece of advice would you give, or what tool to, for as far as what tool to use? 95% of them said budgets. That's how important this is. And you want to meet periodically in order to update this. You don't just do it once, put it on the shelf and move on. You want to keep it alive and fresh. Next, number 3 is the budget's multiple purposes. I've kind of alluded to this before. It just touches so many bases. It allows you to communicate with the employees' expectations, communicate owners' expectations of the employees. So it's a great tool to assist with performance behavior, performance management for the employees. It helps when dealing with lenders, such as the bank, as far as giving them some comfort, some insights as to what to expect. Banks don't like uncertainty. Banks do not like lending additional amounts of money when they feel uncertain. Budgets help give them more certainty. You can borrow more when you have budgets. I know that for a fact. Okay. And then lastly, it allows the owners to set goals. So as entrepreneurial as the owner wants to be, as fast as he or she wants to grow the company, the budgets actually allow them a great amount of control as far as uh, putting that on paper and sharing it with the team members who are so critical in trying to make this happen. So budgets have multiple benefits to them. It's not just an exercise you do, you put on the shelf, and you try to cut costs 5%. It's not that simple. Another factor to consider to get the most out of your budgets is pull them apart. And what I mean by pull it apart is don't look at it only company wide. You get a whole different perspective if you look at a business, especially with multiple locations or multiple lines or services or multiple departments. That when you look at the company overall, I never do that. We look at budgets by department or profit center and really dissect it. And then you bring all those together and then you look at it as a whole. That is, you get so much better insights as far as the company when you do that. You see where the problems are, you see where the opportunities are, and you see where you want to capitalize or not. So again, you want to do either by the department or product line or by locations. However you can pull it apart, do it, and then put it back together when it comes to the ultimate budget or master budget for the company. Number 5, use the proper budget approach. As I've alluded to here, the imposed budget, there's not much management input. This is imposed by ownership. And again, this is the quickest and easiest, and depending on the dynamics of your company or where the company is in its growth, imposed budgets can be useful. The participative budget is really helpful when you're imposing a lot of change in a given year, new location, new staff, new management, anything when you have a lot of change, participative budgets are important. I've also seen that where it's tied into performance bonuses. I'm not a big proponent of tying it exactly into a budget, but people do use the budget as a guide for performance bonuses. So you see that in the participative approach, a negotiated approach as well. That to me is the best of both worlds. Takes a little bit more time, but that's where I've seen most successful companies go, is negotiated approach. And once you do this for a year or 2 years, the employees get comfortable with it. They understand the benefits of it. They also understand the process and what is needed there. We are very involved with the budget process with our CFO on demand clients, because we feel it's so critical and it allows so much opportunity for planning. It's really important to take the time to do it. Number 6, align the budget with performance compensation. I kind of alluded to that before. Compensation incentives when budgets are met. The way that I like looking at it is I don't necessarily tie it directly into if a budget's met, because budgets can be manipulated to a certain degree. And rather than having employees or management try to game the system here in order to benefit from it, I prefer seeing compensation plans where, let's say, an incentive compensation plan for a manager might be if you exceed a certain either volume of business or revenue targets or whatever the case may be, there's a kicker in there. And that target, that threshold, usually is below what the budget number is. So they don't have to worry about hitting a particular budget number. So if your budget is $600,000 in sales, let's say, but the manager gets a compensation for X percent over, let's say, 500,000. So they don't have to worry about hitting that budget. So anything over 500,000 is gravy to to the manager here, and they're not so fixated on hitting a particular number that coincides for the budget. It doesn't have to. Some people do it that way. I don't suggest that. Right, and the last point is refer to the budget monthly. At CFO On Demand, we don't only help them with the annual budget, we keep that alive every single month as we're going through the financials. We will look, we'll refer to what, let's say, the company did the prior year in that particular month or year to date. But that's kind of looking through the rearview mirror. We don't spend a lot of time doing that. We spend a very little time doing that. We're mostly looking forward and comparing numbers to the budget because we feel that's forward thinking. There was a lot of, if done properly, there was a lot of planning, a lot of strategizing. The budget is where the owner wants to go. So we're comparing it to that. We're not looking at the rearview mirror. I kind of say to the owner, like, what do you want these numbers to look like? So at the end of the year, if you do it, everyone gets high fives, everyone gets kudos. Here, I want to know what that looks like because that's where we're focusing in every month. And if we're off track in a particular month, we have the ability to get back on track. You're not looking at this so infrequently that you're so far lost, especially seasonal businesses that have a short window, that there's no way of recovering. So that's why it's critical that you refer and keep this alive every month. Some actually break it down to weekly. And then the last point on the screen is, again, keeping your bank involved with it, especially if you made large investments and large changes. They'll want to see updated information or updated budgets, see how it compares to the budget on a more frequent basis as opposed to, let's say, annually. Okay, a recap of the 7 factors to get the most from your budgets. So one is the process is as important as the outcome. It's the planning, it's the communication, it's the strategizing with key management or employees. It's that exercise then quantified into financials that everyone is committed to during the course of the year is what launches you into success and what's so critical for the budget process. Number 2, it's a great owner communication tool as far as performance of employees, as far as expectations of revenue, as far as growth and changes in the company. It's a great tool of communication, the best tool of communication. Number 3, it has multiple purposes. You can use it for lending, and you can use it for compensation. There's so many different things that you can do with your budget. It has multiple purposes that you'll benefit from. Number 4 is focus on profit centers and location. That's a way of really understanding your company, especially as it grows and you're looking to get into different lines. It's nice to pull it apart and really expose either things that are not working as well in a particular department or that's doing very well and you want to continue growing that part. Pull it apart, we kind of talked about that as far as the actual process of pulling the budgets apart and doing the calculation. You want to align it with performance, compensation, but not such that it's the exact budget number. But again, I think those two should be in line. And lastly, as we mentioned, you want to refer to it monthly. Some people refer to it as the recipe or the roadmap as far as ways to keep everybody on board, especially if there's going to be change during the course of the year. You know, many times, just similar to, again, a game, you go in initially in the year with a game plan, but things happen and you have to make changes along the way. When you do that, you want to see what your initial plan was. Now, I get this question often. I guess this is the best place to talk about this is, when do we change the budget? If we had assumptions in the beginning of the year, something changed dramatically, should we change the budget or are we stuck with it? And the answer is no, you're not stuck with it. I would change it, but I would be very careful in changing it. Only change it when there has been factors in there, mostly that you can't control, that will change the outcome for the year, I would definitely change the budget. It's not something that you're left with because it's going to feel antiquated and you're not really going to be committed to it. So I would change it, but I would change it sparingly. You know, if you lost a particular customer, I wouldn't change it for that because I think people will be less inspired to go find a replacement customer for it, you know, if you lost a big customer. So things of that nature, I wouldn't change it for. But if there was external factors, obviously, if there was a something catastrophic that happened to the business, for sure. But if there was external changes, big regulatory changes, yeah, I would change it as well. But be very uh, skeptical in doing that. In CFO on demand, as we mentioned before, we work with our clients. We think it's incredibly important, and we've seen the benefits to our clients to help them with their financial analysis. Budgets fall right into that category as far as financial analysis. The accountants of the world like recording the past and talk about the present. Futures budgets are all about the future. It's all about predicting where we're moving forward. That's where the entrepreneurs want to look. They know the past, they understand the present, they want help predicting the future. And that's what budgets help you do in the form of financial analysis. CFO on Demand, we do that. We help support the internal accounting department so the business owners can not only just be operators dealing day to day, but they can be financial strategists. And those financial strategists be business operators every single time. We see that no matter what the size of the companies are. And give me an example of business strategist Jeffrey Lurie here, very calculating, plans things out. Jerry Jones tends to go right from the seat of his pants and very reactive with things and very impulsive there. Strategists tend to be more successful over the years, even though they might not have as much money or resources to get the most out of what they have. And again, we'd like to thank our featured sponsor, Sturdy Savings Bank. They have multiple locations in Cape May County and in Summers Point. We encourage you to visit our friends over at Sturdy Savings Bank. And thank you to all of our sponsors. And as I mentioned in the beginning, if you have any questions or comments, you have my email address. I encourage you to send an email, ask any questions. I'll be happy to answer them. And thank you for joining us.